This is another episode of me documenting the day-to-day process that I'm taking to achieve long-term consistency in the financial market. And today's another down 2R day. My second one on the month, but I haven't had a day like this in 2 weeks, which is good. Shows that my selectiveness is improving, my patience is improving, my discipline is improving. But today is not even a losing day for me because I thoroughly followed my pre-market plan. I executed at the point of interest I was looking to execute in my pre-market plan at the right time with the right confirmations, and risk was managed. So is today really a losing day if I did everything right on my end? No. The only thing that I did wrong today was trading before that Powell event that we had on the economic calendar at 12:35, because before then price action was extremely fickle and literally did nothing. That was the only thing that I did wrong today. Besides that, I can't even consider this a losing day because I did everything right on my end, and the trades that I took were trades that I would take 10 out of 10 times every single time. And it was exactly what I was looking for. So can this be a losing day? Absolutely not. The main lesson that I extract from this is, why would I trade before that Powell event? I'm not going to do it in the future because now I know what the market looks like, especially when it's later in the session, right? It's not in the morning session. It's not before the open. Sometimes it does happen before the open. We get good price action in the morning session. But in this case, the market was just waiting for that and waiting for a reason for it to start moving again. And we basically went sideways up until that event. So let's get into it. Today is Tuesday, September 23rd, 2025, and let's read the optimal market approach on how I ended up with a net P&L of $172 down on the day. So how I felt going into today, it's the first thing that I consider, because how you feel about price, your confidence level in your bias. Are you confident that the market's going to go higher, or are you confident that it's going to go lower? Which one? Do you think it's going to go higher with confidence or lower with confidence? Or maybe you don't have confidence in either idea. That's a low probability trading day. So it's the first thing that I'm going to note. Since price has done nothing pre-market overnight, this tells me it's likely waiting for the high impact drivers at 9:45 and especially Powell at 12:35. This means I'm not confident in trading this price action before then, especially if it presents high resistance liquidity run signatures. Basically, I'm going in today already noting that it's going to be a low probability trading day, especially if it presents high resistance liquidity run signatures, which it did, and I still ended up trading it. So like I said, that's the only mistake that I made in this session. I should have noted the high resistance conditions and known to literally do nothing, because that comes down to setup selection, right? The market can present our setup, our model, but maybe there's something on the economic calendar coming up and maybe the condition isn't ideal, that we're going to look at that setup as not worth putting risk behind because the condition's just not right. And there's something coming up on the economic calendar that could affect the probability of that playing out, which is the case today. So the biggest lesson today is setup selection. How are you going to trade around the economic calendar? So the draw on liquidity that I established today was previous daily high, simply because in the overnight session, market came just shy of that high and then turned back inside the range. So my bias for me comes down to 3 parts: higher time frame narrative, market criteria. The blend of those two makes me think, how is it going to get to the draw on liquidity? So it's these 3 elements. So from the higher time frame narrative, which is just my analysis on the daily/weekly time frame, we had a large update on Monday, and that typically marks the low week. The market's at all-time highs, so I want to keep taking buy signatures until it proves otherwise. And since yesterday was a strong up-close candle, I want to look back within that range for new 4-hour to 1-hour discount arrays where it is fair value for me to be a buyer. And then market criteria. The consolidation following the strong up candle is bullish and shows price is comfortable where it's at. Ideally, price takes the low of the consolidation range first, dropping into the fresh 1-hour discount array near yesterday's settlement, and continues higher. So how is it going to get there? How is it going to get to previous daily high? I favor a drop down the high impact drivers that takes the low of the consolidation range, offering fair value to be a buyer. So top down, now I'm just recording my annotations before the market open. You can see the timestamp at 9:15 Eastern Standard Time. Marking my annotation on the daily chart. Okay, now I have a good idea of what the daily is likely going to do. So Monday was a strong up close candle, which typically marks the low of the week. Noting the fresh 4-hour and 1-hour PD arrays near previous day settlement and consolidation overnight, both are a sign of strength. So I'm favoring a drop down. Notice the consolidation range overnight. We have this strong gap on the 4-hour. And we also have the same kind of signature on the 1-hour. So what I want to see is price drop, take the low of that consolidation range, and then continue trading higher. So in the 50-minute, you can see that I note that I'm interested in seeing price respect the 1-hour BISI for a run up into previous daily high. And so both the trades that I took gave me confirmation that that was happening. At the same time though, it kind of was an on the fence trade, because in order for me to confirm a reversal out of this gap, I need to see a close of the candles. I need to see the bodies of these candles respect one of these levels within that gap. And it's just the upper quadrant, the midpoint, and the lower quadrant, or the high and the low. In this case, on the 1 hour, that first large down close candle, does it really respect any of those levels? Not really. It's laid right over top of it. And if you see how the following candles reacted, look where the body stops on that 11 o'clock candle. It stops right below the lower quadrant. So what does that tell you? That tells you this is now acting as premium array instead of discount array. So what I was looking for was basically the market to drop down, take that candle's low, and then trade higher, overlap this down candle, and take these highs here, make a new high a day, because we primed previous daily high. This is previous daily high right here. Mark that. Make it bold. So large down candle doesn't really confirm the idea, but on the 15-minute, this is what I was seeing. That kind of piqued my interest in this idea. I was noting how on the 50-minute, the bodies of the candles still did not leave that gap. Now this gap doesn't entirely fail to me until we do something like this, where the bodies of the candles are leaving that gap. And you can see that we did not get the reversal. We didn't get the second leg lower until the market finally left that gap, gave up the ghost. And then as soon as it did, as soon as it violated the low of that gap, notice how the following candles, they trade up into it, right? But they close below it. So that's a sign of weakness. At this point in time, the market was still giving me signs of strength at 10 o'clock because the bodies of these candles are not leaving the gap. I'm noting how the wicks are trading below it, but the bodies of the candles are still closing inside of it. And I'm seeing the same signature on the 5-minute time frame. And on the 5-minute, I'm noting how all these discount wicks are forming. As the market is driving lower, so this tells me that move lower is losing momentum. A buy could be coming soon, a reversal could be coming soon. I'm noting how this candle dropped, still closed back inside the range. I'm noting how this candle also dropped, but still closed back inside the range. So the second that I get displacement back inside the range, I can show you guys that this is exactly what I was looking for. Pull up the session recording. So one exercise that I'm doing recently that has actually helped me intraday be more patient, be more decisive, be more selective, is just simply annotating the chart, just putting up little chat bubbles on what I think the market's going to do. So you can see that initially, this is what I'm thinking. Price action is fickle. Initially, expected with the 945 driver. I do like the fact that it's trading lower, leaving that buy side intact. That is in alignment with my plan. So if the daily time frame is bullish and I'm looking for higher prices and I'm looking to be a buyer, I want to see the market drop down first, leave some area of buy side smooth above, move away from that, right? Trade lower, make the manipulation leg, the fake move of the day, the Judas swing, and then aim for that high. So that's why I have this labeled as pre-market buy side unfinished business. Unfinished business meaning there's a reason for it to come back there. And this was literally exactly what I want to see to take the market long. So now I'm just waiting for it to make a new low a day, take out that pre-market low, and then give me signatures that it's going to reverse here. Now in this up candle, this isn't a trade for me. Why? Because it has to prove willingness to get over this gap and violate this premium array. Until then, I know that the market's still in a sell program and we're still going lower. So now that it's ran below the pre-market low, I'm seeing if it gives me any confirmations for me to be a buyer. So I'm noting that to confirm the long, it has to get over the gap. So when you literally take these things and you put it right there on the chart for you to see, it's in front of your face, your thought process that's going on is on the chart in front of you, it really makes it easy to make decisions, because now I'm affirming with myself that in order to confirm the long here, it has to get over the gap. And the fact that it never does that never confirms the long. So it keeps trading lower, right? And then I repeat that same process as the market keeps trading lower. I still have no confirmation, but I'm noticing the buy side delivery starting to feel displacement, meaning I'm noticing the strength of up close candles starting to come in, but I don't like the fact that it has left this smooth range or this smooth edge, which is why I make this little annotation here, this trend line. And so I'm noting this strong up close candle, but I'm also noting the fact that we have this large open sell side imbalance bias on efficiency or bearish fair value gap. So the fact that we had this large up candle, but the following trades into that gap for essentially the first time, the first test of this gap, and then we have a large down candle, tells me that this move is still not ready yet. It's not ready. So I'm still waiting. I'm still being patient. Plus we have that smooth edge. I know it's likely to get ran out. Now I'm noting that we're at the start of the macro. And this is also what gives me a lot of confidence in the idea of taking the long for the reversal, because we have literally created equal highs. So as soon as they'll get put in, I am annotating that right there. So it's another reason for me to anticipate higher prices. So I annotate that. Now I'm noting this gap as well. Still giving me signs of weakness around this gap because it's trading up into it and closing below it. So now that the market has cleared out this edge, what I want to see, and you can see it right here, is I'd like to see, boom, displacement here to confirm the reversal. So in order to confirm the reversal, the measure of, I guess, how probable the reversal is will be shown by displacement. So I want to see, boom, displacement back inside the range. And I literally sit here, and as the market is driving below the low or above any high or below any low that I'm looking for the market to reverse at, I do this. I go like, because it has to show me some displacement back inside the range. And so I get that eventually there. So boom, notice the strength of this 1 minute candle. And I'm already anticipating a drive below this candle's low to fail, right? Because I'm looking at the higher time frame and I'm noting how the bodies of the candles are still respecting that gap. Although it's leaving it on the 1 minute, the 5 minute and the 15 minute are still closing within that gap. So it's not officially inverse for me yet. It's not officially failing. And that's when I annotate this. It is leaving this gap on the 1 minute, but if it is still closing inside it on anything above the, and I'm thinking here, I'm looking at the displacement, the 5 minute, that's good. So I'm watching this displacement come back inside the range. I'm noticing how the market has taken out the open price of that series of down close candles. Boom, like that right there. And now I'm flipping the top step X and I'm looking to execute this thing long. Now I have confirmation that we have displacement coming back inside the range. The higher time frame candles are still respecting that gap. Everything is looking good. I'm confident. I'm confident in this long because of the equal highs literally left right here. How we traded lower at 9:30, leaving all this intact up here. I'm targeting that area. So I get tagged in, although I will admit this entry was a bit premature. One of the mistakes that I'm making, what happened to the recording? Come on, man. So one of the mistakes that I'm making, or the situation that I'm continuously put in, is that when I'm anticipating the setup to occur, when I know the reversal is coming soon, I start to feel a bit anxious. And that kind of makes me really, really eager to execute on the setup, maybe before it even has any confirmation. So in this case, I'm buying the market before this becomes a solid up close candle, before the candle even closes. And typically what I need to see, or what I need to do, is wait for that candle to close. In this case, since I know the setup is coming soon because it's giving me the signatures on the higher time frame, it's now the right time. We have the macro, and I'm looking for a drive below this low to fail. As soon as I see, boom, displacement back inside the range that crosses the open price of that consecutive series of down close candles, I'm in. So I get tagged in, and this is the frustrating part. Notice where my stop loss goes. It goes below this candle. Now, because I didn't put it at the swing low, I'm trying to scrimp as much as I possibly can and save as much as I can in terms of risk. I frame the risk on this candle's low instead of that candle's low, instead of the swing point. Now, how do I place the stop loss at this swing point? This session is a different story. I can take partials at these equal highs, and I would not have taken the second loss that I took today, because the entire reason that I put that second trade on, I show my executions here. The entire reason that I put the second trade on is because, if you note, I literally got wicked out because it went one tick. It literally went one tick below that low. And then we had a large up candle come inside the range, and then I buy it again because now I think, okay, I barely got stopped out. Now it's playing out in my favor again. So I buy the market again, and then I stop out twice. So this should have been just one single trade. That's it. This should have been one trade. But because I tried to save as much as I possibly could in terms of risk, framing the stop here instead of the swing low, I barely get wicked out there. And the condition is high resistance, and it's before a Powell event, so my stop should be wider anyways. I have a protocol that states in high resistance conditions, I have to use wider stops. If you don't, that's literally the nail in the coffin. You are asking to get stopped out because in high resistance conditions, the market has wider retracements before it makes the move that you're looking for. So the stop here should be framed safely at the swing low. And it was only an addition of how many points? Let's measure it, of 1.5 points. So instead of placing the stop at the swing low, I'm going to save 1.5 points of risk, and I'm going to put it at that low. Now I barely get wicked out. Then it turns in my favor, and then I'm like, okay, now it's playing out. Execute it again, stop out again. If this isn't the case, then I have the opportunity to partial here. Although it's literally only 20 handles, I probably would have gotten greedy and not done it anyways. But I would have taken only one. I only had one loss on the day, let's say, if I did not frame risk like that. So it comes back, stops me out literally by 1 tick. Not the worst thing in the world. And now I'm like, okay, now I really have confirmation. Now I see large obvious displacement on the 1 minute time frame. Now this thing should reverse and go higher. And I get stopped out again. Boom. So that's it. Took my 2 losses for the day. I'm exporting my trades. I'm putting the trades out immediately. And I know that I am done for the session because I have taken 2 losses. And I never take more than 2 trades in a single trading day. And there you have it. So I'm checking my P&L, looking at the damage done. And I know that my P&L is stair-stepping. And I know that all I literally have to do is show up the following trading day, tomorrow, and do the same thing over again. Because I know that I have created a process where I just come to the market and I do the same thing. And over the long run, it yields profitability. So the trades that I took today were trades that I would take 10 out of 10 times. It just did not play out. I just did not have the bias correct, which is fine because there's going to be days like that. You move on. You do not let that loss bother you because you know that losses are just one little data point in the entire data set, meaning the series of wins and losses is random. And this is shit from like trading in the zone. Everybody knows this, right? But I'm finally getting to the point where my losses do not bother me because I understand that I come to the next trading day and I do the same thing and I can have an entirely different outcome. Now, before, earlier in the month, I would go in like on Thursday on here, right? I have 2 consecutive red days. I think everything is falling apart. I feel like shit because now I've had 2 consecutive red days and I think the model's not working. Everything is falling apart. But what happens? I come to the market the next day, I do the same exact thing, nothing changes, and I have a completely different outcome that puts me up for the week, and I finish the week out green. That's how trading is, man. This shit is really roller coaster. It is really up and down because you could have a terrible trading day, fucking terrible, and then the following day, turn everything around like this, like that. So I'm at the point where my losses are not bothering me at all. I took those losses today, and you saw how I handled it. Immediately, I'm ending the session, I'm exporting my data for the day, and I'm importing it into TradeZella so I can go ahead and start the reflection process that I do, which is simply the daily template that I fill out. And that's it. And you move the fuck on. How you handle your losses is going to define your trading success. And I got that from Umar Ashraf, because while I'm driving, I like to layer things, meaning do multiple things at once if I can, in order to save time and just be time efficient. So while I'm driving, I'm listening to something that is going to be of benefit to me. So I'm listening to a Umar Ashraf video on YouTube, and he mentioned how you handle your losses. How you handle your losses is going to define your trading success. Do you take a loss and do you think that everything falls apart and you need to rebuild your system from ground zero and you need to start over and you need to trade a completely different system? Or do you take your loss and go, okay, I can learn from this. I did something wrong. I can learn from it. My risk was managed too, so it's fine. And I followed my plan and it was fine. And this was a trade that I would take 10 out of 10 times. So I literally just do not care. How are you going to handle your trades? Are you going to feel like a loser? Are you going to sulk? Are you going to lament? Are you going to feel bad for yourself? Are you going to feel victimized and get down and dig yourself in a hole mentally simply because you had one red trading day? Or are you going to shake it off? Know that all you have to do is come to the next trading session, do literally the same exact thing, but you could literally get an entirely different outcome. That's how this trading shit is. And that may be a hard pill to swallow. It sucks, sure, but that's how it is. And if you did anything else, it would be the same thing because it's the ebb and flow of life. Are you always going to be going up forever? Are you always going to be going down forever? No. Neither is true for each one. You're not going to be going up forever. You're not going to be going down forever. There's an ebb and flow to everything. You hit highs and your lows just as you hit highs and lows in your trading. You can hit highs and lows on an intraday basis as well. It can happen on a micro scale as well as a macro scale. So a red day could be a low for you on a micro scale. But there is value in that. You can go in there and extract the lesson that you learned and use it to make you a better trader and just move forward. Knowing that, all you have to do is come to the following trading session, do the same thing over, and get a different outcome. So that's it. See ya.